You can own the S&P 500 and still have more writing on a small group of companies than you might think. That does not mean disaster is coming. It means the word broad needs a closer look. Concentration risk sounds scary, but this is not a doom story. It is a simple investing literacy story. The goal is not to make you afraid of index funds. The goal is to understand what they actually own, what they protect you from, and what they do not. For many investors, an S&P 500 fund feels like the default version of being diversified. Instead of picking one stock, you buy a slice of hundreds of large public companies. That is a powerful idea because one bad company does not have to ruin the whole plan. But there is a key detail. The S&P 500 is not usually owned as 500 equal pieces. Most funds that track it are weighted by market value. Bigger companies get bigger weights, smaller companies get smaller weights. So the index can be broad and uneven at the same time. Market value is roughly the price of a company's stock multiplied by the number of shares. If the market says one company is worth much more than another, a market cap weighted index gives that company more space in the portfolio. The index is not trying to be fair, it is trying to reflect the market. Imagine a classroom of 500 students, where the seating chart is based on height. Everyone is in the room, but the tallest students take the front seats and the most attention. The smaller students still count, but they do not shape the view nearly as much. A broad index can become top-heavy without anyone making a dramatic decision. If a few large companies rise faster than the rest, their market values rise too. Because the index follows market value, those companies automatically become a larger part of the index. This can feel like a loop. A company performs well, investors value it more, its index weight grows, and index funds now hold more of it by design. That does not mean the price must keep rising. It only means the index follows the size that the market assigns. Concentration risk means your outcome depends more heavily on a smaller number of holdings. If the biggest companies do well, they can lift the whole index. If they struggle, they can pull harder on the whole index. The risk is not that the fund owns too few companies. The risk is that the largest companies matter much more than the smallest ones. If you like calm explanations of investing concepts without hype, this is a good time to subscribe. We are going to keep the focus on how the system works so you can understand the risk without being pushed into fear or overconfidence. Think about carrying a grocery bag. If the weight is spread evenly, one item breaking is annoying but manageable. If most of the weight is in one glass jar, that jar matters a lot. The bag may still contain many items, but the risk is concentrated in the heavy one. Concentration is not automatically bad. Sometimes the biggest companies became big because they built strong businesses, earned large profits, or created products many people use. A market cap weighted index lets winners grow inside the fund, instead of forcing the fund to sell them too early. The uncomfortable part is that size and quality are not the same thing. A company can become a huge part of the index because expectations are very high. If those expectations become too optimistic, the stock can still disappoint, even if the business remains important. When you buy a broad market index, you are not just buying businesses. You are buying them at current market prices. If the biggest companies have high prices compared with what they eventually earn, their future returns may be less exciting. The index does not judge whether the price is attractive. It accepts the market price. Passive investing often sounds like doing nothing, but it really means following rules. An S&P 500 index fund follows rules about which companies are included and how much weight they receive. The fund is not asking whether the top companies are too popular. It is following the recipe. Passive investing can protect you from some common mistakes. It reduces the need to guess which single stock will win. It usually lowers trading activity. It can help investors avoid chasing every new story. These are real benefits, and they are why broad index funds became so popular. But passive investing does not protect you from market risk. If the whole market falls, the fund can fall too. It also does not protect you from valuation risk or concentration risk. If the market itself becomes very excited about a small group of companies, a market cap weighted fund comes along for the ride. A common misunderstanding is that owning the S&P 500 means owning a neutral and perfectly balanced version of the economy. It does not. It is a specific slice of public companies, weighted in a specific way and influenced by whatever the market is valuing most highly at the time. The S&P 500 is often used as a shortcut for the stock market, but it is not the same thing as the entire economy. It does not include every private business, every small company, every worker, or every household. It mainly reflects large public companies and the prices investors place on them. Concentration can also show up by sector. If companies from one part of the market become very large, the index may lean more toward that sector. This can happen with technology, energy, finance, or any area that dominates investor attention during a certain period. This is why two investors can both say they own the S&P 500, but the risk they are taking can change over time. The fund name stays the same, yet the inside mix shifts as company values rise and fall. The wrapper is stable. The contents are always moving. Some people hear rebalancing and imagine the index trimming winners back to equal size. That is not how a market cap weighted index usually works. If a company's market value grows, its weight grows too. The index does not automatically cut it back just because it became large. One useful comparison is an equal weight version of the same group of companies. In an equal weight fund, each company starts with a similar slice, so smaller companies matter more and mega-sized companies matter less. This is not automatically better, it is just a different set of risks. Equal weighting can reduce dependence on the largest companies, but it can increase exposure to smaller or less profitable companies. It may trade more often. It may behave differently from the headline index. Every design choice moves risk around. It does not make risk disappear. Another way investors think about concentration is by looking beyond one country. A domestic large company index can be very useful, but it is still tied to one market. Global diversification spreads exposure across more economies, currencies, industries, and political systems, though it also adds its own complexity. The point is not to hear concentration risk and immediately abandon a broad index. Overreacting can create new problems, like higher costs, random timing decisions, or a portfolio that becomes too complicated to stick with. Understanding risk should make you steadier, not more frantic. A better question is not, is concentration good or bad? A better question is, what am I depending on? If a few top companies drive a large part of returns, are you comfortable with that? If not, what kind of diversification would actually fit your goals and behavior? Concentration risk feels different depending on your time horizon. A long-term investor may accept periods when leadership is narrow, because leadership can change over time. Someone who needs money soon may care more about short-term drawdowns. This same index can feel very different depending on when you need the cash. There is also a difference between what you can financially handle and what you can emotionally handle. Risk capacity is about income, savings, time horizon, and obligations. Risk tolerance is about whether you can stay calm when your portfolio drops. Concentration can test both. One practical habit is to look under the hood of any fund you own. Check the largest holdings, the sector mix, and how the fund is weighted. You do not need to inspect it every day, but knowing the basic shape of your portfolio can prevent surprises later. You do not need a market prediction to understand concentration risk. You do not need to know which company will rise or fall next. The concept is simpler than that. If a few holdings have a lot of weight, they can have a lot of influence. The S&P 500 can be a broad, low-cost, useful tool, and it can still be top-heavy. Those ideas can both be true. Passive investing can remove some bad decisions, but it cannot remove the basic reality that markets rise, fall, and sometimes crowd into the same winners. If this explanation helped, leave a comment with your biggest question about index funds, diversification, or portfolio risk. You can also suggest the next finance topic you want explained in the same calm, beginner-friendly way.